but I was aware that it was there. And my initial skepticism was driven by the fact that, eCash and DigiCash and Hashcash and other things like it had failed. I mean, throughout the 90s, after the internet was developed, the 80s and 90s, there were alternative cash systems that were being proposed that, more or less they all failed. And so the notion of separating money and state has been around for a while, but nobody successfully did it until Bitcoin. And so when I first heard of Bitcoin, I had a natural reaction like, oh, that's a nice idea, but it won't work just like all the other ones. So, I kind of like people today, the way they throw Bitcoin in with all the other crypto, they don't realize there's a difference. But so I started toying around with it 2013 or 14, but I kind of forgot about it. The next thing I knew, it was up 3 or 4x what I paid for it. And I thought, shoot, this is really working. It hasn't broken, and maybe I need to pay attention to it. So I started digging in deeper. And the more I dug in, the more I realized that it was technologically sound, and my fear of technical failure, which was my initial concern in the early years, slowly faded away. But we went through some things. We went through the block size wars, and there were several hard forks, and none of them really took. But there was a lot of, in the beginning, it really was very much viewed as an experiment. And I went to a show in 2017. Of course, then the bust came, and all those crazy valuations came back down to earth. And so I kind of thought this is a pretty good time to kind of shift gears. And my family wanted to move. We were in New Jersey. We wanted to move back to Boston. So we did that. And I changed firms, and I set up my own investment firm focused on investing in what I call growth at a reasonable price, which is, companies that are growing. I mean, the thing that worked the best in the technology field is when you found something that had revenue momentum and the multiple was still cheap and it had a lot of growth in front of it. What would happen with those is the multiple would expand and they continue to grow. And so you got outsized returns. So I wanted to try and do that in other areas and set up my own firm to start doing that. Was doing some things in China and India and so forth because they were growing. And then the GFC came along, and the GFC kind of really shocked me. And it didn't shock me that it was happening. I was actually short a lot of the tech stocks or the housing stocks going into it. But what shocked me was the government response, where they said, oh, we're not going to let this stuff fail. We're going to print money and give it to the banks. The banks paid record bonuses 1 year later. And, Ben Bernanke had a chance to test out as an Austrian, having studied the Austrian economists. I kind of knew that intrinsically, there was something wrong with the picture. And the thing that's wrong with the picture is that you can't grow the level of debt faster than the level of GDP without eventually having the two disconnect and having a problem. I mean, that's, you're going to have the debt's going to fail, or you're going to have to grow GDP very quickly through inflation to support the debt. But there's no mathematical solution for what they were doing. And so it became very clear to me that monetary debasement was now a feature, not a bug, that they were going to have debasement on a go-forward basis for a long time. And so after 2008, in my fund, the fund I was doing things in China and India with, I pivoted and started. I said, okay, we're going to have inflation here. What do I want to be in if we have inflation? And it's very clear. I looked at the last inflationary decade, which was the 70s, and the two best performing categories in the 70s were oil and gold. And so I thought, well, I'm going to invest in gold. But gold's pretty dull. It just sits there. It doesn't grow. It doesn't pay dividends. So I thought, well, I'm going to invest in companies that mine gold. That's interesting. And so I became a specialist in picking gold mining companies as stocks.
Wonderful. So you talked about the Fed lowering interest rates to zero, government printing money after the crisis, and that leading to asset inflation. Are we all effectively playing a game of musical chairs where the Fed and Treasury control the music or asset prices through monetary policy and Congress through fiscal policy? How do you think about that?
It sure feels that way, doesn't it? I mean, the book I wrote describes the way that the Fed got put into place by Greenspan following the 87 crash. And, it's the Fed has two mandates, stated mandates, stable prices, which they define as 2%, and then, healthy employment or full employment, which I think they define as, 2 or 3% unemployment. And, but they really have a third mandate, which is stable financial markets. And what we've seen historically in their behavior is that whenever the financial markets get a little bit, which is what they did, M2 went up 40% in 2 years. And guess what? Things are going to look good from a growth, spending, et cetera, point of view. What they don't look so good from is an inflation point of view. I mean, as we know, when they did that, inflation went up to 9% at one point. Now, they've squeezed it, and theoretically it's coming back down with these higher interest rates that Powell has put in. But we all know, one, the inflation numbers are a little bit cooked, so that probably what they're coming down isn't entirely numerically accurate. I think that while the economy looks healthy and has been ticking along, I think underneath it all, there's a decay taking place, and you see that in statistics like credit card delinquencies and student loan delinquencies and houses days for sale, number of houses on the market. I mean, I feel like all that stimulus, provided quite a jolt, and a positive jolt, for a couple of years. But we're now at this stage where it's going to wear off, and they've either got to take another hit of stimulus, or we're going to enter a downturn. And what's troubling is that we're running a 6 or 7% of GDP deficit in an economy that's pretty healthy. Rewarded the people who brought on the crisis. I mean, that just made no sense, and was just grossly unfair. So, yeah, part of the error I think they made there. I mean, okay, so you got a crisis; it's big. I get it. You got to solve it. Fine. You got to print a lot of money, take interest rates. I get it. Okay, now it's 2011. Crisis is 2 years away. World hasn't ended. Everybody's kind of working away. Well, why are interest rates still at zero? Do you know what I mean? Why? Because they ran that policy from late 08, all the way to 15, and then they ever so slowly started creeping up. So that's 7 years of free money, basically, and that's a real distortion. And not just 7 years of free money, but 7 years of growth in the money supply as a result of the QE transaction. So it's a broken system, and as I argue in the book, interest rates should not be set by a policymaking group of 12 people sitting around a table. Interest rates should be set at the point at which there are people who save money and they want to earn interest on the money they've saved, and then there are people who need money and they're willing to pay interest in order to guarantee everything. They guaranteed Silicon Valley, they guaranteed First Republic. They forced them into mergers. They tried to sell them off originally, and everyone looked at them and said, we're not touching this. This thing's got a big hole in it, right? So there are no buyers. But then, they ended up giving subsidies to the purchasers and said, look, if you buy this, we'll give you a break over here. And so they found buyers for both of them. So, I guess what I'm trying to say is, at the end of the day, the government will always find ways to keep the system going to protect itself. Those ways of doing that will always involve printing money, as they did in those cases. That printing money will always lead to inflation, as it has, and will continue to do. And so, as an investor, as an individual, what's the bottom line? The bottom line is you've got to own things the government can't print, forms of money that the government can't print, because the government can print dollars, the government can print debts, so to speak, but the government can't print gold. The government can't print Bitcoin. They're physically, one is physically limited in supply, and the other is mathematically limited in supply. And so, because of those limitations, compared to everything else, they will appreciate in value very rapidly, and they have. I mean, we're in a sovereign debt crisis, and since the beginning of 2020, the price of gold is up. In general, when you have a currency event, owning stocks is not a great idea. Despite the fact that the Venezuelan stock market was one of the best performing markets ever during the year when they were undergoing hyperinflation. Good luck getting your money out.
So. Yeah, another question here about SVB, because we're really just trying to understand what should the, at least immediate term solution be, right? So as I understand it, you are also a customer at SVB, yet it seems like you believe the government should have let, again, here, capitalism play out and allowed SVB and other impacted banks to have run their course.
Right.
Can you walk us through your thinking about this? And just to clarify, were your deposits with SVB insured at the time?
Well, they were, because I didn't have over 250,000 in there. But to be totally fair, I mean, and this is also one of the reasons why they use the systematic risk exemption. I mean, the FDIC, which provides that deposit insurance, right? I mean, there are $17 trillion of bank deposits in the world, and I think most of which are uninsured. I mean, there's a small number that are below the 250, but many of them are not. And the FDIC fund that they use to make depositors in failed banks whole is, last time I checked, it was like in the 190 billion range. So calling them fair value assets, and but they're not. They're generally warehoused at a value above and beyond what they're really truly worth in the market. I think when the day comes, if they do recover and they are worth a certain amount in the market, well, then they can sell them and let them run off. But that's reducing the money supply. And so my sense is it's kind of a roach motel. Whatever assets they buy, they just end up stuck at the Fed. But I'm not 100% sure that's the case. I mean, there may be some that have been sold off, but you know, the system is like a shark. It's got to keep going forward to, you know, to breathe. And so you got to have more money and bigger balance sheets and more circulating credit, or else you can't pay back the old stuff. And that's why some people said it's a Ponzi scheme, because you have to continually bring in new money into the system to make sure that the old money stays, you know, quote unquote, money good, that it doesn't fail.
That's funny because I thought Bitcoin was a Ponzi scheme. I don't.
Yeah, well, that's what everybody says, but you know, who's the Ponzi in Bitcoin? I mean, in the Ponzi scheme of the money being run by the banks and the government are the Ponzi. I mean, they're benefiting because they monies. I mean, the German, you know, Bundesbank was one of the most conservative banks, central banks in the world, and you know, the German mark was an extremely strong currency post World War II. You know, all the way up until we got into the real late stage fiat post 71. You know, the Swiss in the same situation. Their currency was very, very sound. But the trust in the currency is really like saying the trust in the politicians and the central banks, because the politicians and the central banks manage the currency. They have the ability to change the reserve requirements. They have the ability to push the interest rate up and down. They have all kinds of powers and ability. They have the ability to bail out a failing institution, which is what they did in '08. They have the ability to print money. And so once you give all these abilities to the, you know, to the central bank and the government, and they're really kind of, you know, hipped at the joined at the hip, so to speak. Once you give all these possibilities, all this power to these people, you got to believe they're not going to abuse it. And the fact is, you know, there've been a lot of examples of how they will abuse it. Oh well, just a little bit. We'll just, you know, we need to keep the wheels greased. We'll just print a little more here. Well, okay, fine, but that shows up in inflation. And so, but back to, you know, how it's going to manifest. I mean, we got to sell even more bonds. And so it's a rinse, wash, and repeat. You know, it's a negative feedback loop that gets worse and worse. And so what I'm watching very carefully, what I think is a big signal for the next crisis enveloping us and for the big print, therefore coming soon after, is the bond market. And we've seen little, you know, squiggles around this. We saw Liz Truss have a problem with the British bond market in 23 or 22, I think it was. We saw our bond market in the fall of 23 went through 5%. The Fed came out with a lot of jawboning to get it back down, said the rate hiking cycle was over. You know, there talk recently about, you know, a return to QE. You know, the Treasury Department has been buying some of our bonds with some of the TGA, which is the government's checking account. So they're, you know, the Japanese 40-year bond the interest rate there has been going up very sharply. And that was always a currency in a country that had a big carry trade. So, you know, all of these things are kind of starting to say to you, hey, there's smoke around the edge of the theater. Maybe there's a fire. And if we get to the stage where the bondholders realize, oh my God, they can never stop printing money and they're going to print a ton of it, this is a legitimate fire, you know, just to kind of, and that's putting fingers in the dike. But I think eventually the dam is going to burst and they're going to have to do a really big print.
Hey, we won't hold you to that exactly, but we'll be looking.
Well, that's fair. It's fair enough.
But you know, Larry, as we were talking about before we even started the episode, I graduated from Harvard Business School as did you, but I graduated a year ago, and during my 2 years there, I was never assigned to anything that seriously explored the cycle of excessive money printing that led to these boom and bust dynamics.
Or Austrian economics, for that matter, which is a really good model for understanding all this, right?
Yeah, and it could have been in an elective course I didn't take.
Sure. I don't think it was there anywhere, because I looked for it when I was there too. And well, Harvard Business School is very much a piece of the establishment, and the establishment protects itself, and the establishment likes the system that it has. And we haven't gotten deep into Bitcoin yet, but you know, the establishment doesn't, you know, it's working for them. They're doing well. They're winning in this game, and so I think that's one of the reasons why many of them have kind of an antipathy towards Bitcoin. They just don't like it because the ledger, from their point of view, you know, it relentlessly is deflationary. And, you know, if we have AI doing the work of lawyers and if we have robots doing the work of factory workers, those are all salaries that aren't going to get paid. And, you know, those people who are earning those salaries today, it's dependent that they continue to earn those salaries so they can repay their debts. And so, you know, it's what Jeff Booth so brilliantly puts out, and I talk about it in my book, where we've got a system where you have to continually increase the debt and the credit and the you've got to increase the monetary base to keep the system running because the system's built on debt. And yet you've got deflation, which is very anti-debt, which, is going to drive the price of everything down. And so the two systems, they're trying to achieve a differing goal. And the inflation, it's going to take the three biggest governments in the world with nuclear weapons, China, Russia, and us. I'd rather have our government be the strongest of those three. So the whole idea of having a strategic reserve and having our government buy Bitcoin, that's okay with me. The government's role in this whole thing is kind of interesting and tricky. I mean, they originally ignored it, poo-pooed it, and that was one of the great concerns 5 years ago, talking to people. They said, yeah, it's a great idea, but the government's going to shut it down. Well, then the ETF got approved and Donald Trump got elected and the strategic Bitcoin reserve got put into place. And now it appears highly unlikely, at least in this administration, the government's going to shut it down. Make a footnote there because there's something to come at the end of that. But the government should be, in my view, buying and stacking Bitcoin just like they buy and stack gold to defend their currency. And because I think this will become the future currency. Now, one thing the footnote is that, we're in a red.
The U.S. has already established a Bitcoin reserve, as you mentioned. If they actually start to accumulate, let's say they do, and other countries follow, and Bitcoin eventually becomes the world's reserve currency, do you see some sort of risk there? For example, if the U.S. already owns more gold and Bitcoin than any other country, the two main hard assets that could actually challenge fiat dominance, wouldn't that actually incentivize the U.S. to go even further with more money printing since there's no longer another hard asset?
I hear your point. Yeah, I mean, possibly. But until they really link the money to those two assets, the fiat, I mean, they've got a fiat doom loop going on. And yes, if they own more of the other assets, that'll make them look, generally speaking, better off. But they've really got to get all the way. They've got to take the next step, which is to link that fiat dollar to these sound assets. Because until they do that, if these assets keep going up in price, the faith in the dollar is going to get lost. I mean, it's already been substantially dinged. Trust is a funny thing. When you lose it kind of all at once. And so this is a very, repeatable, well-known pattern throughout history where, empires get too big, they overexpend, they run deficits, they take on debt to run the deficits, they print money to cover the debt, and then ultimately the currency fails. I mean, it hasn't happened with the world reserve currency in a long time, if ever, although it probably happened in Rome. The Roman denarius failed. But I mean, it's certainly happened in smaller countries, plenty of them. And so when you behave a certain way, you're going to have a currency crisis. I mean, Zimbabwe, Venezuela, Weimar Germany, Argentina multiple times, Brazil multiple times, China, Russia. I mean, after the wars, all these countries have experienced this kind of currency collapse. The U.S. just hasn't experienced it. I mean, we had a soft default, we had a collapse with the hyperinflation of the Continental, and after the founding of the Republic, we had a soft default with the greenbacks, but they were able to actually bring us back to the gold standard after that. And we had a further soft default when
like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support. Enjoy the video.